Hey, guess what the 30-year mortgage is at right now? Just guess. It's October 28th today, and 2024, and we just had a 50 basis point rate cut. So we were down, but we're back up. We were down to under 6.5, and right now we are at 7.0. And we were at 7.0, and the Fed chairman, Jerome Powell, cut rates. It was great. Didn't really stir up activity in my area, but you know, they tried. But then we also got hit by hurricanes, so that wasn't good. But either way, they're back up, and it doesn't surprise me. I think one of the biggest problems within interest rate cuts has to do with the profitability of banks. You know, banks do get to write the loans, and they get to either sell it off and make a little quick buck, like a quick flip, or they get to hold the loan in their portfolio and, you know, keep collecting the money on that. So one of the things that is happening right now, that even the great financial collapse in 2007 and 8 and 9 did not have, is the realized and unrealized losses that banks are having. And I think that's partially why the banks decided to bump the rate up. You know, they kind of like went down for a short time, and then literally less than 1 month, and we're already back up at 7%. So let's talk about a little bit about bank failures to start with. I think we might have some bank failures coming up. You know, we had Silicon Valley Bank fail a couple of years ago, right? A lot of people, the investors that is, lost their money. And then what did the Fed do? They came out and they actually bailed out a lot of the people that had their money in there. You know, somehow like it changed hands or something like that, where the shares were sold, or I'm not really sure, but basically the government paid out to those people that had deposited money. And because of the location and the nature of the customer base there, it ended up being a lot of people with huge amounts of money. It wasn't like spread out like Bank of America has, you know, tons and tons of people with like, you know, $1,000 in their account. It wasn't like that. It was people with like, you know, 20 million. The FDIC insurance only covers $250,000, which is crazy. It should be adjusted for inflation every single year, but you know, then we might have a real problem when bank failures do happen. So the investors of that bank ended up losing, but the people holding the money in there did not. So what we're having right now is the following. This is kind of crazy. The US banks have about $750 billion in losses on real estate debt. Okay, so that's a lot of money. That's a big number, okay? I don't know what percentage that is of their total you know, income, and I don't know if they're how much they're still profiting. But in the real estate sector side, the commercial real estate sector, which I just did a video on saying about what's happening with the increase of foreclosures in real estate, right? In commercial real estate. Those are gaining a lot of traction, okay? That video kind of talks a little bit about how all the foreclosures are happening, but what it's not getting into is the details of the losses that the banks are going to have. And pretty much the losses are here, but they're not being reported on the books. They're not being reported out there everywhere. So when you see $750 billion of losses from real estate, that's only a part of it, because there's more bad news. This is actually 7 times larger than 2008. You remember what happened in 2008? You know, Lehman Brothers collapse, and that caused a very, very big problem. And that basically was the turning point for the great financial collapse, right? The Lehman Brothers failing. And by the way, my name's Maciek Zaremba. I'm a real estate agent in Sarasota, Florida. And right now I am walking right across the street from Celery Fields back there in Sarasota, Florida. Oh, this is interesting. This area here has just been labeled as an alligator habitat. I mean, these are lakes in Florida. That's pretty much what an alligator... Florida is an alligator habitat. What are you even talking about? Well, let's do it. I guess they have entry signs, so they're just like, hey, warning, don't go here, there's alligators. Well, okay, so here's what we got. We have 7 times more losses than in 2008. Well, this article, this is a little misleading because this 7% is than 2008. Well, what time of 2008? Very, very important. I think all the losses weren't being reported and weren't on the books yet. Like these losses aren't on the books. So it's not really fair. They're making it seem worse than it actually is, but that doesn't mean it's worse than it was in 2008. Okay, because one of the things that banks are doing this time around has to do with basically continually extending the notes. So let me give you an example. You bought some commercial real estate. You got a 5-year mortgage at 3%. Well, what they're doing right now is, as this loan is coming due and you have to refinance, they go to the owners go to the bank and they say, hey, listen, I'm pretty much going to default. I cannot pay this mortgage at any rate higher than 3% or 4%, whatever they got it locked in at. And the bank says, whoa, don't default. You need to refinance. And they say, can't. We've tried. We can't refinance. It's just not going to work. So then go in and they say, okay, well, as of next month, we're going to stop making the payment. And then they say, well, before you do that, why don't you just continue making the payment? Why don't you just continue making that 3% payment? We'll extend you for a short time, right? This is the delay and pray method of what banks are doing. They're basically saying, don't worry about it. Rates will fall, you'll be able to refinance soon, but for now, let's not make us lose money. The bank, let's make us not lose money. Well, the delay and pray method seems to be working for now, but this is not a long-term strategy. This is just for now. So what happens when, let me ask you, what happens when you stop paying your credit card bill and the credit card company's like, we'll give you 2 more months to catch up. We won't report you to your credit report, but we'll give you a little extra time. Well, in 2 months, you're in trouble. Or like when COVID hit, right? What did they do about mortgages? They're like, hey, your mortgage, you don't have to pay it right now. We're not going to be foreclosing on anyone. We'll let you not make payments for 12 months and then you can pay it all back later. Well, in 12 months, it's a lot harder to come up with all that money that you owe, that you didn't make payments on, even though you had 12 months of ease, okay? So, and it worked out in COVID, right? And it might work out this time around, because what happened in COVID is prices skyrocketed. So now, if you didn't make payments for 12 months because you lost your job, you got furloughed or whatever, well then your property went up in value in 1 year so much that you sold it, you paid off those 12 months of payments, and you made money on top of that, okay? And that might happen. We don't know what will happen with commercial real estate. All we know is that right now, they've already lost $750 billion, the banks, due to bad commercial loans, and they have another $515 billion, so not quite the 750, but they have another 515 in unrealized losses. And unrealized losses is what hasn't hit the book. It's like they haven't maybe finalized that foreclosure, maybe they haven't written it off in the books, maybe some other situation. I don't know how the balance sheets work for banks and the income statements, for the banks work, but they have another 515. So is this a precursor to another couple bank collapses? And why do I say that? A couple, because it's usually the small banks that took on a lot of these loans. The small regional banks, like in my area, there's Florida Central Credit Union, for example, or Achieva Credit Union. These are small local credit unions, basically like a bank. There's other ones, there's other small banks, and they are the ones that loan locally. So what they did is, they had $1 million loan here, a $2 million loan there, and it will just start adding it up over years. of commercial lending that is now at a much higher interest rate. So their money is tied up at a much higher interest rate. They're losing money. And if someone is not making the payments, it's even worse, a lot worse. And what happens, which we see in bank failures in general, what happens is, once it's no longer profitable to run the bank, they close up shop and they file for bankruptcy, restructuring, and they'll foreclose on everyone they got to foreclose on, pay back the investors as much as they can. And people that invest into that bank take a hit. They lose some money. But there is one good piece of news out there, is that remember when BRICS was talking about no longer using the US dollar as the being the petrodollar? Well, it's interesting that not much has changed since that has been changed and implemented, and in general the whole conversation has kind of died down out there in the news and social media reporting, because right now 49% of all oil is still being bought and sold using the petrodollar. So there's still a very high demand on US currency, and it is giving me a little bit of optimism in terms of the survival of the US dollar, and just making sure that it doesn't end up getting completely devalued through hyperinflation, because if no one needs the US dollar, they're going to sell their bonds. They're going to sell, and people are just going to get out of it, right? That's really what ends up happening, and we've seen this in many cases where countries' currency has basically been devalued because of a lack of international demand, and I don't have any examples because that's not my field of expertise. But I will say that if that starts happening to the US dollar, where it's just not needed by foreign countries for commerce and exchange and oil purchasing and selling and so on, this is going to be a really bad thing, because the value of the dollar is going to go down from that. I mean, obviously it's like people are going to sell it because they're not going to need it. It's a weird conversation, because it's just like a theoretical bank kind of selling. It's not really like you go and you sell something to someone else. Well, they do, but they do it in very large numbers, right? How much they will sell. So having a decrease in the demand of the US dollar is probably going to cause very big problems domestically. I don't know how that's going to relate to real estate, though. I'm just not as familiar. If you think let me know what you think. I think I'm going to research this a little bit and report back, because I'm in the real estate game, and you're watching Florida Real Estate TV. So just maybe you might be interested in exactly what that's going to do. Now, I do still think the last thought that I have is about what I mentioned the other day in a video, which was about hyperinflation. Okay, hyperinflation, the more I look at things, the more I'm reading about it, and I have been reading quite a bit about it. Man, it is not looking like too good. If we have this hyperinflation situation that I'm a little bit afraid of. There are some benefits here, but basically all it means is that your money's going to be worth less than it is today. It also means that your properties are going to go up in value. So hey, buy now and wait until hyperinflation kicks in, and then pay off your mortgage with future dollars. Because if you're making $100,000 a year right now, and we have 5 years straight of hyperinflation, your $100,000 job is probably going to increase, disproportionately, but it's probably going to increase quite a bit, where you might be making $160,000 for the same job done. Okay, not through promotions or anything like that. So that could possibly be, good for certain people, but when it comes to the general, cost of everything, it's going to go down. I mean, the prices are going to go up. The purchasing power of your dollar is going to go down dramatically. And it's a really, really good strategy for the US government. That's the scary part. That's why I'm afraid of it, is because it just makes sense for the US government to do this. They're going to not only pay back their old debts faster at lower dollars, future dollars, which will be lower than today's dollars. So they're going to pay it back faster. You're going to pay your loan back faster. In fact, anyone that has loans and money owed is going to win. But the very, very rich people that loan money out to funds or to whoever, they're going to be getting future dollars which are basically undervalued. And I don't know what's going to happen to interest rates and so on in those kinds of situations, but usually I think they're going to go down if that's what happens. I think that's going to be part of the reason why it could happen, is that interest rates went down, so therefore the hyperinflation component is going to be stronger for that, and basically the reason is because that as interest rates go down, people borrow money, and is going to make people invest more money, and then they're going to make more money, and the whole money supply goes up and up and up. I don't know, what do you think?